Hello everyone, I'm Ray, your senior insurance agent. My earlier video talked about the difference between buying funds on the bank platform and the insurance company platform. This episode will continue to discuss the topic of funds with you. The episode will explain the meaning and the difference between mirror fund and direct funds. There are two types of funds in the investment fund platform of insurance companies with different charging model and performance. The first is direct fund and the other is mirror fund. Direct funds buy funds units directly from the fund companies, and their pricing is the same as the daily trading price announced by the fund companies. This can also be checked on the relevant fund companies and the major financial websites. High transparency. The mirror fund, as the name suggests, is a shadow version of a certain fund. The insurance company bought the copyright of the fund and issued a fund that was extremely similar to it. After the insurance company has discovered a potential fund, it will buy the copyright from the fund. After buying the copyright, they can know every investment strategy of the fund manager and then imitate it. In the end, the two funds will have roughly the same proportion of the asset allocation, so it looks roughly the same on the surface. But it should be noted, the fund price can only be checked in the insurance company that provides the mirror fund. In addition, in terms of the charges, since the price of the mirror fund is linked to the trend of the direct fund, theoretically, the returns of the two should be the same, but this is not the case, because the mirror fund itself also has the management fees and administrative fees. Usually it's 0.5% to 1%, plus the copyright fees. There is a chance that there will be a heavy charge, and these fees will be reflected in the price of the fund. Therefore, the mirror fund's return will be less than the direct fund. After deducting all the fees, the mirror fund will not buy all the remaining funds into the direct fund, but will reserve a small part of the funds to meet the requirements of the investors to redeem or switch funds. Although this move can improve the investment flexibility, this is also the biggest advantage of the mirror funds. You can complete the fund switching procedure on the same day, instead of requiring several days to complete the switching operation between the funds like direct funds. But the disadvantage is that the trend cannot be 100% linked to the direct fund. If it encounters a very big bull market, the returns of the mirror fund will have a chance to be inferior. So objectively speaking, if you are a short-term fund investor who wants to switch funds on the same day, I think the mirror fund times is good for you because of the flexibility. However, if the investor adopts a long-term investment strategy and does not switch funds frequently, I suggest you can choose an insurance company which provides direct fund products as much as possible. Because compared to the mirror funds, direct funds have a higher annual return. With the compound interest effect, the long-term return gap cannot be ignored. Finally, to know whether the fund you are buying is direct fund or mirror fund, you can observe it from the name. For example, the China Equity Fund issued by the XX Fund Company, whose name is XX China Equity Fund. It is a direct fund. If the name of YY Insurance Company is added to this fund, it becomes XXYY China Equity Fund. Very likely, the fund is a mirror fund. Therefore, when you buy a fund, don't because of the similarity of the fund's name that assume that the returns will be the same. You must pay more attention to the type of the fund. If you don't understand, you can always seek advice from the trust insurance agent. Okay, this is all of the information of the video. Hope it's useful to you. Don't forget to give me a like and subscribe. Thank you so much. I'm Ray. Hope can be your most trusted and lifelong insurance agent.